Talking house loans this morning, housing loans, difficulty in getting them. Have you been rejected recently? 1300 903 222. What did you learn about the process with some of these changes around increased expenses, amongst other things? Anton is a mortgage broker. Hello, Anton.
Hi, Rob. How are you?
Good, Matty. What are you seeing at your end?
Yeah, look, definitely. I mean, I've been a broker now for 20 years, so it certainly makes me a bit of an old fart now in the industry. But I'd say it's probably the toughest it's been for about 15 years. And it really does come down to the living expenses that lenders are now using in their assessment of loans.
Yeah, give me a price here. I mean, it's gone from an average 32,500, I think, wasn't it, or something like that?
Look, yeah, I mean, I guess it was always worked out depending on number of adults in the household and the number of dependents. They came back to a dollar figure. So, and I guess what we're also seeing now is some lenders are also saying not only based on the client's budget, but the higher the income, the higher the living expenses should be as well. And this is already on top of when we look at how much someone can borrow. We're not using the actual interest rate. I mean, let's face it, most people should be, their home loan should be in the 3% range, high 3. We're having to assess loans at 7.5% to 8% interest rate, so almost double.
And that is because it gives the lender assurance that if there is a rise in the interest rates, they're covered because the borrower's got a bit of fat, so to speak.
Yeah, exactly right. I mean, let's face it, lenders don't want to put people on the streets if they can't afford their home loan. So, back when rates were, in the 8s and 9%, it always just used to be 1.5% above whatever the rate that you were getting on your home loan, that was the margin.
Yeah.
But as rates got lower and lower, it got to a point where they said, look, we're not going to go any lower. So 7.5% to 8% is where most lenders are assessing loans at the moment.
So when you're telling your clients, sorry, I can't get you finance, can they go anywhere else? I mean, are there any other ways to get money at the moment?
Look, I mean, I guess there's still low doc loans out there to a point. They have to be a little bit more substantiated than perhaps days gone by. You're still talking, needing BAS statements, needing accountant letters. So, look, no, I mean, there's no shortcut. I mean, I guess years ago, as lenders could look outside the square a little bit and someone might be asset rich but income poor and they'd try and get it to work. And most of the time that's worked out fine. People are their own worst enemy a little bit because, people that knock on the lender's doors wanting money, and then as soon as they get into trouble, it can't be my fault. Let's blame someone else. And then governments step in and say, okay, well, we've got to legislate to protect people from themselves. And really that's why we're in the situation we're in a little bit.
Yeah. Okay, mate. Thank you, Anton. Let's go to it with a little bit more detail. Martin North is here. He's a financial expert from Digital Finance Analytics. Martin, I think we've heard about some of the changes there, but essentially these are APRA and RBA-based changes, aren't they, to cool the market, to stop some of this extraordinary lending, which we're seeing in the Royal Commission, of course?
Yeah, so if you go back over the last decade, there was very, very loose lending in Australia. The household debt-to-income ratio is very high. So households have massive amounts of debt, way more than they probably should. And this is now an attempt to try and put it back to a more normal set of realities. It's partly, as you say, the regulators, partly the outfall from the Royal Commission. But on average now, your borrowing power, in other words, for a given set of income and expenditures could be down by 20 to 30% compared with what you got a couple of years ago. And that means that, of course, one, people are sitting on mortgages that perhaps are bigger than they can really afford. And two, if you try to refinance them now, you're going to find it very tough. And so a lot of people are getting rejected. About 41% of loan applications are currently being rejected compared with 5% a year ago. So
Wow.
This is a huge change.
What will the knock-on of that be? Surely that's going to have huge economic impact.
Yeah. So the simple point is this, that home prices are driven fundamentally by credit availability. The more that credit is available, the more home prices go up. As credit gets tighter, home prices slide. That's why we're seeing home prices sliding now, and my expectation is that we're going to continue to see this.
And we haven't even seen the recommendations yet from the Royal Commission, which could have further impact.
That's the point. So my point is this is this first stage of a series of tightenings. So this is not the end of the tightening. It's not a short-term adjustment. This is a fundamental resetting of the way that the lending industry for home loans is going to work. That's going to have a profound impact on lending, the banks, individual households, but also broader economic impacts too, because of course as home prices fall, then the wealth effect dissipates, people are going to perhaps spend less, so there's a really risk now of effectively spilling over into more significant economic impacts too.
I did read this morning that some comments being attributed to the RBA in some of their minutes where they were reflecting on whether or not some of the changes may be impacting the pipeline of supply, and perhaps there could be a thought to whether or not they look at that and maybe even loosening some of that. Have you seen that? Is anything in that, do you think?
Yeah, well, of course, there are a lot of people saying, hang on, we need to go back to much looser lending again because we need to keep the credit cycle going and the building and construction cycle going because they have been the economic drivers of the economy for a decade, right? My argument is yes, but you've got to understand the risk in the system now. We have too many households with too much debt. The debt-to-income ratios are way too high. So this, to my mind, has got to be pushed into, and it's going to have an impact, clearly, but we can't just react and say, oh, we made a mistake, let's go back to where we were. We have to actually become more disciplined. People need to be able to actually deal with the fact that the amount of debt they've got is already very high, and we mustn't allow it to get any higher because that's an economic risk for them as well as the broader economy. Yeah. But this is a really, we're in a difficult situation now. We've had a long party, a decade of partying around home prices and free credit, but it's changing, I'm afraid. And I don't think it's going to...
What do you think will come out of the Commission? What do you think are the likely recommendations? Are economists thinking about that? Are people talking about that?
Yeah, I think there's going to be much more focus on banks acting for their customers rather than just maximising profit. I mean, the Royal Commission said that the banks have been greedy. I think we perhaps all agree with that. But now this is really focusing on delivering the right outcomes for customers. There may be some restructuring. There may be some cultural messages there too. But at the end of the day, if we end up with customers getting a better deal, with loans that they can service more effectively, then I think that's probably going to be a good set of outcomes and probably a long time coming.
But if we've already got a higher stress test with that buffer zone of interest rates that Anton was talking about, and we've also got the expenses being more individualised for these loans, like where else could regulation over lending come in? What else could they look at?
I think you'd look at mortgage brokers and how they're remunerated and specifically what their role is, because at the moment that's unclear. I think you could also look at, of course, the banks only see a sort of a little part of the overall household financial picture. We've got positive credit coming in, which means now they'll get more information about the total loan exposures of households. That's going to be a significant change too. But I think ultimately you come back to the culture of the banks and the way that they work, because the banks are there to help consumers do things and businesses do things, not just to maximise their own profits.
Yeah, but if we can't get a loan, if we can't refinance, we're not getting helped, are we?
Correct, but then you've got to understand the systemic risks by continuing to lend too loosely, and that is probably a bigger risk.
Thanks for your time, Martin.
Good to talk to you. Thanks.
Martin North. Yeah, interesting, isn't it? From Digital Finance Analytics.